Elevance Health, the second largest insurer in the US, has fallen 45% in 1 year. But why has the stock dropped? And is it a compelling buy? That's exactly what we're going to be covering in this video, along with what does Elevance Health do, their Q2 earnings, why I prefer ELV to UNH, their Unseen Moat, and my valuation on the stock. Let's get straight into it. So is ELV the best opportunity in health, down 45% from a year ago? Now, to know the answer to that question, we need to know, what does ELV do? Now, Elevance Health is an industry juggernaut in US health insurance. It's second in memberships to UNH. The company offers employer, individual, and government-sponsored coverage plans, and it is also an emerging player in pharmacy benefit management, PBM, and other healthcare services. Over here, you can see the states where Elevance Health is mainly based. You can see the 14 states in blue where they offer their Blue Cross or Blue Cross Blue Shield plans. This is where the majority of their focus goes. And they have a small Medicaid presence in a few other states, but they cover a very small amount of states in comparison to UNH, which actually you'll see further down the video is an advantage. So why has the stock dropped? Well, higher medical costs and decreased Medicaid memberships are squeezing Elevance's profits. It's a similar story for most of the healthcare insurance industry at the moment, but essentially during COVID, medical visits in 2019-2020 were depressed, and this was good for the stock because it meant that there were less medical visits for the insurer to pay out on. But now there's a rebound since COVID is finished, and ELV didn't foresee the medical visit increase in 2023, 2024, and 2025, which is a bad thing because in this industry, margins are very thin. And this means that this has huge effects on profitability. Obviously, this is not good for the stock and has really affected its earnings. Also, you can see here, Elevance Health memberships has also been dropping since 2023. It was at 48.1 million, now down to 45.6 million. And this is due to the government doing Medicaid redeterminations. Essentially, the government was allowing a higher rate of membership for Medicaid during the COVID era. And since then, the government has decided to redetermine who is actually viable for these Medicaid payments, and this has caused a large drop in the amount of people that are able to use Medicaid, and you can see that reflected in Elevance's memberships. Also, what this does mean is the people who are leaving Medicaid are actually usually more healthy than the people who are still on Medicaid, so it means a higher acuity, which essentially means you've got a sicker population of members within Elevance Health, which is also bad because that will also increase the medical visits. Now, it is worth noting that revenue has still grown, and it's continued to grow this quarter, 10.2% year over year on a trailing 12-month basis, and 14% year over year on a quarterly basis. So here you can kind of see the revenue percent change over time, and here is the revenue in millions. So 187 billion in revenue last quarter, trailing 12 months, obviously. So if the revenue is growing, just how bad is the situation? Well, Elevance Health had previously forecasted an EPS range of $34.15 to $34.85 per share. They've recently updated their outlook, and it's now for $30 in EPS for 2025. So over here, I've shown what that looks like. Now, this is actually an increase from where we are at the minute at $23.50 a share. It's a 28% increase from where we are at the minute. You might be shocked by this considering that UNH's EPS forecasts were actually very much lower, and they're very different. And from what we've seen, UNH usually leads the pack in medical utilization trends. So there is a possibility that the goalposts could move lower for Elevance Health. But to counter that, UNH has a greater government exposure. So Elevance has a 26% government exposure, whereas UnitedHealth has a 39% government exposure. And what I've done here is I've just added up the total Medicaid and Medicare memberships for both companies. So here you can see UnitedHealth with a 15% Medicaid and 24% Medicare of their overall memberships. And then with Elevance, it's 20% and 6%. So there is less exposure for Elevance here. If you don't know what Medicare and Medicaid is, essentially Medicare is government-sponsored health insurance that covers for people who are generally older than 65 or who have a qualifying disability, and then Medicaid is for families and children with limited income and resources. So in UnitedHealth's case, they've seen a lot of increased costs in the Medicare sector, whereas Elevance has seen more in the Medicaid sector because they're more exposed to Medicaid. And also they've been losing members in the Medicaid sector, which is why they've obviously decreased their EPS over the past couple quarters. So their key metric, as I highlighted last time in my UNH video, is the medical care ratio. And it's a key metric for health insurers, representing the percentage of premium revenue that is paid out in medical claims. So as a stupidly low example, let's say that health insurance was $100. ELV would have had to have paid $86.40 out to pay off health costs for that insurance, and the rest they get to keep as, profit. So ELV's medical care ratio in Q2 2023 was 86.4%, and ELV's medical care ratio in Q2 2024 was similar at 86.3%. Now, it's only very recently that we've seen this huge increase up to 88.9% in Q2 2025. When this number goes up just by 3%, because their margins are so thin, you get a huge reduction in EPS, like we saw in the previous slide here, where we've gone down in June 2024 from 28.5 down to $23.5 in June 2025. Now, what could save them is a demographic shift in the US will mean increased healthcare. So you can see here demographics. This was from 2000, a huge population in the 40s, 50s range, and obviously that has slowly shifted. You can see this large jump here between 60 to 70 basically, and now that's moved between 70 to 80. So we're about to see a very large increase in revenues because of all of the healthcare that is going to have to be provided to these people as they get older. This could support stocks that face lower margins because they would make up for the losses in margins in an increased revenue. So in that case, their earnings per share will not decrease. This is one thing that could save a lot of healthcare stocks, especially if they actually start to price their insurance correctly, which would obviously increase their margins and normalize their margins. And in Elevance Health case, management has said that margins will normalize. They're on a multi-year plan to stabilize margins. In ACA, which is essentially the individual insurance marketplace, so it's comes under the commercial sector, they've already repriced products for rising costs. In Medicaid, they say they're proactively engaged with state partners on the upcoming rate cycle. So in other words, they are talking to the government and negotiating with the government to receive higher pay rates for the next lot of Medicaid insurance. And this should hopefully bring the Medicaid margins back up again. Now here on the right, you can see that net profit margins have fallen from 4.1% in December 2018 down to 2.8% at the moment due to the ongoing pressures as mentioned. Now the average over this time period is a 3.82% margin, just to point that out so that later in our valuation you can understand where I'm coming from. So why do I like ELV over UNH? Well, essentially, to start, there is no litigation risk. UNH is currently involved in a few lawsuits with the DOJ, and ELV is not involved in any of that. So luckily, they avoid that completely. Although UNH might actually easily pull through these investigations with the DOJ, it's still a lot easier to just avoid them completely by investing in ELV. So they are also in the early stage expansion in other health related services. So when it comes to other health related services, I'm talking about Carelon, which is an integrated portfolio of whole health solutions. So they're not just the insurance, they are also providing healthcare. And this approach has worked for larger insurers like UNH, where they've got Optum and Optum RX. Essentially, it can improve their margins because they are the ones providing the healthcare in certain situations, and there's no markup between the insurer and the healthcare provider. Now, in ELV's case, they have Carelon and Carelon RX, which are in the beginning stages of growth, and because of this, I think it could help it grow faster than UNH and other established peers. Now, on top of this, ELV has the Blue Cross Blue Shield branding, which is the most recognizable and trusted franchise in US health insurance, according to Morningstar. Now, moving on, they have a concentrated market share in 14 states, which gives it network effect and cost advantage. Now, network effects and cost advantage are two types of moats that I believe that ELV does have over some of the competition. So here's why. Elevance Health, let's say they have their large pool of 1 in 3 people within these 14 states are with Elevance Health. So they have a large pool of customers. Now here are the healthcare providers such as hospitals or other practitioners, and they say we want access to that large growing membership base. We could lower our prices because we will have more members after we lower our prices and gain access to Elevance Health. So this is exactly what they do. They lower their prices, and then obviously Elevance Health goes, yep, that's a deal. We'll take that. We'll take those prices. They are good. They help with our margins. So now we can provide cheaper insurance than our competitions and or more benefits than our competition. This, along with the Blue Cross Blue Shield brand, is just really compelling to the consumers, and therefore they come along and join the large party. So how is this how does this benefit Elevance? So to put this more simply, we can see that the increased members within Elevance Health means that you will have increased providers, which will mean cheaper prices, and the loop can just continue, giving Elevance Health a unique advantage in the states that it operates in. It really does have scale leverage. Onto my revenue assumptions for the stock. You can see over here the revenue percentage growth rate since December 2018, and average is actually 10.2% during that time. So my assumption for my valuation is a 7.5% CAGR, which is much less than the average. Just to be conservative, this is what I'm going to put into my calculator. Now, margin assumptions, you can see here the margin declined. You saw this earlier, and my margin assumptions is 3.5% net income margin by 2030. So from 2.8% down here to that 3.5% level again. I think this is perfectly reasonable, not quite back up to those stupidly high 4.5, 4.7 margins, or up to 3.8, which is the average here. You can see the average 3.8. So this is lower than average. And yeah, I'll put this into my assumptions. Now, in terms of the shareholder, I have an assumption of 2% share buybacks, which you can see here, the median is 1.9%. However, with the price of the stock so low at the minute, I do expect management to be buying back shares quite heavily. And you can see in the last 12 months, it's 2.9%. Pretty sure in the last quarter, it was nearer to 4% share buybacks, which is crazy to see. And then at the top here, you can see the dividend yield currently sitting at 2.09%. So if you were to buy now, you'd have a dividend yield of 2.09%. So my assumptions are just 2% share buybacks. So here is the PE ratio over the past 10 years, and you can see that the average is 17.11. PE ratio. We're currently sitting at 13.58. So after all of these assumptions are input into my ELV EPS growth calculator, you can see revenue CAGR 7.5, net income margin 3.5, buyback estimate 2%, dividend yield 2%. Over a 5-year time period, if the company continued trading at its current PE ratio, it would offer a 14% return with no dividends and a 16.52% return with dividends. So even if the PE ratio was to stay historically low, we would see a 16.52% CAGR, which is still outperforming the market. That is a 2x over 5 years. Now, when you look at a 14 PE ratio, so just slightly higher, you're getting a 17.46% return with dividends. But my target PE of 16 gives us a 20.58% return from the current price of $319 a share. 20.58% CAGR gives us a 2.5 times return in 5 years, which I just think is 100% something I want to look into. Now, if you were to assume that the PE ratio was going to travel back to where it historically has been, the historical average of 17.1, you'd be getting a 22.17% return, which is obviously amazing. All of these returns are very good. I think that this is quite a conservative estimate. So this return looks very, very promising. But here's the thing, the bears will say that the insurance and PBM industries will likely remain targets of regulators aiming to reduce the healthcare cost burden on society. So this could be an ongoing issue. They'll also obviously point out the mismatch in rates and medical utilization is constraining profits in the near term, which I do believe obviously there will be a turnaround, not near term, but a bit longer term. And they could also say the bulk of the insurance membership growth in the long run may stem from the lower margin government-sponsored plans, creating a structural headwind to insurer profitability. Now, this last one will most likely be true considering the population is aging and they may be likely to go onto Medicare. But we'll see how the government handles this and whether they just continue as they have been or whether they make huge radical changes. Even then, you still have super investors buying into the healthcare industry, Warren Buffett buying into UNH, as well as Michael Burry quite recently. Now, with everything today that I've said in mind, I actually have bought the stock. I've only put £1,000 into it because that's all I have after payday to put into my account. But it is a nice little position, currently sitting at 2%. I do want to increase the position, so hopefully Elevance stays quite low. It's currently sitting at $319 per share. I'd like it to stay around there. That is my buy-in price at $319. Really annoying because it went up 3% on the day that I bought it, and I bought at that peak. Here is the rest of my portfolio for reference. Obviously, my Fair Isaac buy was very recent, last week, and it's already up 10%, which is great to see.
I'm hopping out Ferraris. My house is 3 stories. I'm still independent cause jobs couldn't afford me. The meetings were boring. For real, I was snoring. The VP was fine, yeah, she treated me kinda corny. But that's another story.